Moving on to our next panel discussion. As an asset class, venture capital has matured significantly in the last few years and has become an attractive addition to sophisticated investor portfolios. However, investors are no longer looking at VC funds as pure play investment vehicles, but rather as long-term strategic partners, finding innovative ways of deeper engagements with the GPs, such as co-investments, leveraging their networks to help portfolio companies, etc. Our next panel focuses exactly on this, the future of LP-GP dynamics in India. Ladies and gentlemen, please welcome our panelists, Mr. Prasun Gajri, Chief Investment Officer, HDFC Life, Mr. Mihir Vora, Senior Director and Chief Investment Officer, Max Life Insurance, Mr. Ajay Rajan, Country Head Transaction Banking, Yes Bank, Mr. Kapil Mantri, Executive Vice President and Head Corporate Strategy, Jindal Steel and Power Limited. And we also have Mr. Neeraj Gambhir, Group Executive, Treasury, Markets and Wholesale Banking Access. Neeraj is delayed by a few minutes and he should be joining us shortly. The session will be moderated by Mr. Vikram Gupta. So Vikram, please come to the stage. Would like to remind the audiences, please share your thoughts and views on social media using our hashtag IvyCap Day 2022. Absolutely, just in time. Thank you so much, everyone, for joining us today. Vikram, stage is all yours.
Thank you. Great. So I know that it's been a long day for many of you here, and I know that quite a few people watching us online as well. And I was just watching the number of people, and it's quite interesting. A very large number of people actually watching us online today. So this is a hybrid event, which is actually the first time we are doing a format like this. So thank you so much for really joining us today. And we have a very, very interesting panel here. We have two bankers, we have two insurance companies, we have one corporate/family office here. So it's a very diverse panel. And I think one of the biggest questions that typically people want to know is how the LPs, the limited partners who really invest in venture capital, private equity, how are they viewing the world and how are they really looking at investing in this asset class? And I think would love to hear from the horse's mouth straight away. So let me start with Prasun. I think Prasun, of course, you've been investing now in this asset class, and I think, and thanks a lot to all of you, in fact, to actually support IvyCap. Some of you invested for the first time, and I know both Prasun and Mihir have invested twice with us. So I would like to understand, maybe from each one of you, in terms of what goes into selection of a fund manager. So how do you really decide who to invest in?
I wish I knew the exact answer to that. To be honest, it's an evolving process for us. When we started around, 6 years back, we had a vague idea how to go about it. So we made a few selections. But as we have gone along, I think we've learned a few lessons. And those are our guiding principles in terms of selection of a manager. Lesson number one, I think, is very clearly you are fairly simplistic though. I mean, you are betting on a team. You are betting on the people who are going to invest your money. So your ability to understand what those people think, what they have done in the past, what exactly is their plan? Do you think that plan is really implementable? Are they over-promising? Are they under-promising? So kind of get a judgment on the people. Number two, I think, which we have found quite fascinating actually, coming from public markets, where over a period of time, the performances do tend to average out a little bit. But at least in the private space, at least my understanding and my learning has been that funds which have done well in the past tend to do well in the future as well. So it's not a guarantee, but that is, I think, an important aspect of it. Therefore, very clearly look at how the past performance has really worked out. And then get into the details of the past performance, individual names, whether it is well dispersed, whether it is one name really driving it. And Another important factor for us is the difference between gross and the net IRRs. Because the bigger the difference, the worse it is for us, right? So, and I've seen a number of, let's not call them techniques, but number of ways sometimes this difference is more than it should be. And we have kind of learned to think through that and question that pretty much at the start. So these are some of the things. So what matters for us clearly is we now don't really do first-time teams. Nothing to do with the quality of the people in those teams, purely because we believe this is a 8-10 year closed asset class for me. The money is going to come at the back end. I would really want to see that team to at least stay together for a while, whether they kind of perform well together. They may have done very good when they were alone. But can they kind of do the same job when they are operating on their own rather than under the umbrella of a larger organization? So these are some of the factors. So no rocket science here, pretty much it. And the final piece for us is, where does it really fit into our scheme of things? Where in my portfolio does this asset class kind of fit in? So that, I think we have evolved a fair bit of idea in terms of where it will fit in. Where would a VC fund fit in? Where would a growth fund fit in? What are our return requirements? What are diversification requirements? I think we have a fair idea about that. So these are some of the things we get into when we select a manager.
Very interesting. Mihir, would love to hear your thoughts as well in terms of how you look at evaluating managers in this.
Sure. I think Prasun covered a lot of important aspects. One is, of course, we are very reluctant to go for first-timers because of the lack of track record. The key people might be stars, but what we are looking at is institutionalization of the whole process. So we have a very detailed due diligence document which goes into all the aspects, apart from the commercials, of course, the fees, etc. But we really dig deep into whether there is enough bandwidth at the analyst level, at the investment committee level, at the fund manager level, and whether they have adequate number of people to, in fact, monitor the investments. Because sometimes, the people originating also end up being the people monitoring, which may not be the healthiest thing to do. So whether there are separate people for monitoring and ongoing handholding of the investments. So, I mean, there are very good people with very good track records in their erstwhile companies, but whether they will be able to hold the team together for 7, 8, 10 years is not sure unless have a long enough track record. So we really go into the background of everybody, the bandwidth available at every level, and what are the incentive structures for each of the individuals in the fund, starting from the analyst level, at the controller level, at the fund manager level, and the investment committee or board level. So we really are deep into governance, and of course track record matters. What we have seen is that because we have limited choice in the VC space, most of the big funds in India are international. It's only the last 5-7 years that we've really seen the AIF structure coming into play and VC space. So what we have done is maybe we may not wait for the fund to end, the first fund to end, but at least 4 to 5 years of track record of origination, investment, monitoring and ripening or whatever you call it, and exits. At least a few solid life cycles of investments is something that we would definitely like to see. And in our case, of course, like Prasun also, we invest across asset classes. It's not only venture capital, but it's private equity funds, it's structured debt, it's venture debt, it's microfinance debt, real estate debt. We've invested across the whole gamut of funds, but the principle and philosophy remains the same.
Awesome. Thank you so much for that. Kapil, I think this is the first time you invested in a venture capital fund, and I know that I've had this discussion with many of these corporate and especially promoters. If it was only based on returns, then they would argue that their business would probably generate more returns than investing in an asset class which they don't really understand much. If it was only for returns perspective. So I would just like to understand what goes in your mind when you're deciding on investing in a fund like IvyCap or any other fund.
So yeah, first of all, thank you very much, Vikram and IvyCap, for having me here. It's really with such a powerful fellow panelists. So it's an amazing feeling and a very august gathering. So thank you for pulling this off. Really, really impressive. So I think just to I think most of Mihir and Prasun has covered most of the points on what goes in a fund selection. Just a couple of more points there. So one is the focus on ESG and SDG, right? How much to what level that goes. I mean, obviously that by itself cannot decide your investment decision, but the fact that somebody keeps that in mind while making investment, that's one factor which we liked when we chose to partner with you. What sectors is a fund focusing in? That's something important for us. And another thing for us specifically is the co-investments rights, right? We were very clear that, okay, we want to partner with somebody who gives us co-investments rights so that, so one is making returns, right? But, but in the scheme of things, right, the returns or the amount of money we invest here is not going to make or break it, right? But also an idea to get an exposure to something which is so exciting, overwhelming, I mean, many of times we don't understand. So I remember just when Zomato became public, and just compared some numbers, right? We are at, and I hope there's nobody from Zomato or Zomato investor, and just picking a name because that's what. So we, just to give a comparison, we did a turnover of 57,000 crores last year. Zomato did a turnover of maybe 4,500. We did an EBITDA of 15,600 last year. Zomato was negative 1,400 or something. We did a PAT of 8,500. Zomato was negative 1,300, right? Our gross block is almost nearing 1 lakh crore. I mean, Zomato obviously won't have any gross block, so to speak. And our market cap is 43,000 today. And Zomato's market cap, even after this steep fall, is 55,000 crores. Now, there's something which we don't understand, right? Obviously, all other people here will have a different perspective, but this just doesn't add up. I mean, we always heard cash is king, but there's something beyond this. So, I mean, we thought when we can afford to explore this sector, and obviously, one idea was to invest directly into the companies versus doing VC fund investment. So we chose that to begin with. I think we don't have the bandwidth, we don't have the acumen. So let's go with a fund. And we met a few people thanks to your persona, convincing power, your credentials, and constant followed by a Mansi. So we and we're happy with this decision. But at the same time, I think we are looking at some individual investments, more in the field and sectors which we understand, right? Which we can relate to, which has some integration to our existing businesses. So yeah, that's how we're trying to walk in this area.
Very interesting. Thank you so much, Kapil. Ajay and Neeraj, you're both from the banking world, and people would love to hear, what goes on in your minds when you actually look at investing in this asset class. So would love to hear that. Maybe, any one of you can start.
Hi. First of all, thanks, Vikram, for having me here in IvyCap. As a bank, investing in venture capital funds in the current form is relatively new game for us, about 2 odd years old. The way we are structured, there are multiple parts of the bank that come together to decide which fund to invest in. We have a team which looks after what we call as NEG, New Economy Group companies. The main purpose that they have in mind, or rather the main objective that they have in mind, is expanding their coverage of this universe. These are all new age startup style companies, which we believe, some of them we believe will become much, much bigger over a course of time. There's another part of the bank which addresses the needs of institutions such as yourselves, right? As funds, you require banking services, whether it's custody, related to FX, transaction banking related stuff, etc. And the third part of the bank that comes together is strategy team, which looks at the absolute returns that we are expecting out of these investments. So I think it has to be a confluence of minds across these three teams to say this particular fund is something that is probably going to help us reach our objectives in across 3 areas. obviously, the track record of the fund is the first and foremost criteria for us to look at, as everybody else has said. Highly unlikely we will go for a first-time fund. At the same point in time, what investments have you made? What sectors have you made in? The investments that you have made across various funds, what is our view around some of them in terms of bankability, our ability to transact with them, etc. Those are the important areas. We know that the returns from fund are going to be very back-ended. It's maybe multi-years game. And therefore, our important consideration for us is what do we expect as business from either you as a fund as well as the investee companies over the next few years, right? Which could be transaction banking, FX, custody, whatever else that I can talk about. So these are some of the areas that we kind of tend to look upon. Like I said, it's new for us. We haven't yet seen the full returns out. We will see how this thing plays out over a period of time.
Great. Ajay?
Yeah, thanks, Vikram, and thank you for having me over. So, as cliche as it may sound, but I think I'll echo what Kapil said. It probably, and you have recently, Ivy has gone through the whole process, so I guess you and Mansi know it firsthand. So, I think to a large extent it has been your persona and Mansi's persistence, which has been a very critical factor. But having jokes aside, see, as a bank, like I think Neeraj alluded, right? It is not our primary objective to to do equity investments, right? And more so unlisted equity investments. So it is alternate class of investment which a bank will end up doing if it adds strategic value to the bank as a whole, right? And so this is where a couple of factors obviously come in. One, what is the quality of the fund, the pedigree, the past returns, what kind of portfolios, is the fund managing? I think that to me is a very critical factor. Like even the first fund, which we did, as an investment, it got announced as well. Even though it was a greenfield fund on the fintech, but it was a first greenfield fintech fund. So for us, intuitively, it made sense, to have invested in that fund, right? The subsequent funds, of course, Ivy and, the other fund as well. For us, what was very important is the quality of the fund manager, the investment thesis, how do you go about selecting your funds, what kind of analysis you do, what kind of sectors are the portfolio companies working on. Because from our perspective, what we are looking at is, of course, aside the fact what Neeraj mentioned in terms of the banking services or opening accounts and so on and so forth. So all that is ancillary that I can even do organically as well, right? So, but what is important is that do I get access to a portfolio company or a portfolio set of companies who are solving for real problems, who I can use for two aspects. One, if the bank needs a certain use case or a certain development which we are doing, which we believe that if we get it done through a fintech or a startup, could be much more agile, could be much more quick, could be much more cost economical as well. Can this portfolio set, offer me, those kind of companies? That is one. Second, as a bank, we also have millions of customers who also have needs, which as a bank, it may not be a banking solution, right? It may be beyond banking. Can I then use this portfolio set of companies to run a accelerator program or give a use case, to these set of companies saying, solve for this, and I can then use it for my customer, right? So all of these, in addition to everything else, which everyone said, could be some of the factors which are there. And Kapil, I'll just end up with your example of Zomato. So if I can give you some solace, as a bank, we've been a tech-first bank, and we are probably the country's only startup bank, right? So given that ethos, we've been probably, powered the most number of unicorns and unicorns in the country today. And, I just look at some of the valuations that they are in, and they have been banking with us right from day zero, right? So if it is of any solace to you today, whatever is the market cap of the bank versus, some of them who we have actually helped grow from day zero, it's, I probably have a bigger grudge than what you're sitting with. So we should have started investing much earlier, is basically
Awesome.
what I would
Very, very interesting. So I think, Ajay, part of the next question I was going to ask, I think you already answered from your perspective. But let me understand maybe from both Prasun and Mihir's perspective in terms of, and also I think, Kapil, you also mentioned about strategic side of investing in terms of co-investments and other side to it. But let me understand from your perspective. So beyond just the returns, there's a strategic angle. And what is the strategic angle that you see into these kind of investments?
No, clearly, while we may not have that many use cases as a bank may have from the fintech space, as an insurance company, we run a fairly active program of scouting startups. In fact, one of our programs runs with IvyCap as well. And that is a program whereby we try to engage with the startup ecosystem and try and see which use cases for us really can be solved by the startup ecosystem. So when we look for a venture fund, that automatically becomes a part of our thought process. So what kind of companies is the venture fund investing in? And is that something which is going to be key for us from a business point of view? So I think that is always there at the back of the mind when we are making these investments. So that is one. Second is on the co-investment side, frankly, I think we are restricted more by the current regulations. While the overall regulations to invest in AIFs are very conducive, so RDA has kind of made those fairly simple and easy to implement now. But as far as the older regulations are concerned, insurance companies cannot invest in private limited companies, and most of the investments of these AIFs are in private limited companies. So the co-investment piece becomes a bit tricky for us. While we have done one or two of such transactions, are exploring more, but those become very tricky because the companies are in the early phase of their growth and they are not really interested in trying to convert from private to public because they see it as a hassle. So therefore that becomes a bit of a challenge. But if that changes at some point of time, I think co-investment would also become a very strategic piece for us. We'll be very happy to allocate capital towards that and run that as a separate program.
Mihir?
Yeah, for us, it's a similar experience. One is the private limited issue. And second is there's a 10% cap on the equity. We can't buy more than 10% in any company. So that also may be a constraint at some point in time when it's very small companies, But on the other side, it's opened up a whole new area of co-investments for us. While we haven't really fructified anything yet, but in the last couple of years, we started about 5 years ago. But in the last couple of years, we've started encouraging the funds that we invest in to start showing us active co-investment opportunities. So we have evaluated quite a few, and not only in the fintech space, but even in our broader portfolio, we do realize that we are able to get insights into certain sectors, segments of the market, of the economy, which are not in the listed space. So while a bulk of our portfolio is in the listed space, of course, and AIFs is a very small part of it, but because we have started investing in PE funds, VC funds, and the likes, and now that we are monitoring the portfolios on a quarterly and half-yearly basis very actively, we have started engaging with some of these unlisted companies way before they go public, and that's really helped us into getting an insight, and it also gives us a perspective on some of the listed players, because typically when the company is small and unlisted, they tend to be more informal, they tend to be more open to discussing business models, etc. And in the listed space, of course, we are restricted by insider regulations, so we can't really go beyond a point and dig into the companies. But it's much more fun and much more of a learning curve in the unlisted space.
Interesting. I know that you mentioned, Ajay, and even Neeraj, that you just started investing in this space, right? So you wished you had started investing earlier. In fact, I remember 2011 is when we started, and our first fund, we had 15 institutions, and quite a few of them were actually banks. Like we had State Bank of India as our first, on the banking side, investors like PNB and Canara Bank, quite a few other banks. And of course, the regulations have emerged over time. So we're talking about the time when the venture capital investment, not even called AIFs, it was called VCFs at that time. So very different regulation regime. But I would like to understand, maybe from your perspective, how you see the regulations, specifically influencing your thought process. And do you see regulations still to be constraining, or do you think that there are opportunities to make some further, changes in the regulations which can actually free up more of your bandwidth and space to do more in this space?
So let me maybe first qualify the other part. So far, see the investments that we've done. So what I meant is the conscious investing into a fund, is something which we started. Obviously, there are strategic investments that the bank have always been making, some regulatory, some others. Of course, where there are share pledges, there is also forced equity partnership which we end up having. So all of those are anyway, there. But you're right. As a bank, there are always a regulatory framework within which we need to play. Again, Reserve Bank is not. It's not your normal course of business to do equity investments or make money out of equity investments. Your investors or even regulator does not expect that your revenue pool X portion has to be, equity returns and so on and so forth, right? It's predominantly NII, fee, FX, etc., which are what is expected from a bank to deliver. So having said which, there is, so any equity investments does attract almost 150% capital. So it is, fairly expensive for us to do, these investments. Then, of course, there are constraints that you cannot go more than 10% stake in a company without prior approval from RBI and so on and so forth. So if you ask my personal view, I don't think RBI is going to, in a hurry, relax any of these regulations, because it is not, they don't expect that the banks are in the business of doing equity investments and generate returns out of it. It is more debt. And if you actually look at it, the past discussion that we've been having, they do expect that the banks should give debt to this sector of startups, and they've given the priority sector lending benefit also there. I don't foresee that to come across on the equity side. So, but there is enough leeway that the banks have, even within whatever is permitted norms, of what is allowed. So I believe that the banks will continue, to invest, and I do see more and more interest emanating out of, banks and financial institutions to get into this space. I think the next decade is clearly going to continue, there is going to continue to be a lot of action in this space, and we will see more banks coming in. So even if, there is a higher capital charge which is there, but I think the returns will compensate, for that. So I think this decade is going to see more of this action or momentum going on.
Got it. Neeraj, would you like to add to that?
Yeah, just a couple of points. One is that currently it's applicable to VCF. When we invest, for the first 3 years, we're not supposed to mark to market. It goes into our hold to maturity book. After 3 years, we are supposed to mark to market the positions, and that requires some kind of NAV of the investment, right? So if that time frame is extended a little bit more, it gives us less worries about how the mark to market will play out. Of course, currently the size of investment is much smaller than what we carry otherwise. I mean, if you look at a bank's book versus the AIF investments that you've made, it's much, much smaller. So I don't think the absolute size is that much of a constraint. There is a whole host of regulations, as Ajay mentioned. But I think given the size of the balance sheet that banks have, there is a significant runway of increasing this, provided our experience is good, provided we are able to get good returns and good outcomes that we are set out for ourselves.
So while we are at this topic of regulations, I know that insurance is also guided by the IRDA guidelines. How are you looking at this? Would you like to have maybe some changes in the IRDA guidelines which can give you more flexibility, or do you think, given what it is right now, you are able to achieve your purpose in terms of investment in this space?
So as far as the quantum of limits is concerned, I think it's fairly adequate at this point in time. It's 3%, probably can go to 5%, but we are not even using the 3%, so that's fine. But I think in certain special cases, like Prasun mentioned, private limited companies should be allowed if it's meeting a certain definition of startup or venture funding kind of a thing, then that would help further in the co-investment piece.
No, nothing to add. I think that is the only one. Other one is a more generic, which becomes a pain point with some of the funds is, but insurance companies by law today cannot invest in companies incorporated outside India. And therefore, whenever you're investing in a fund, they have to carve out the insurance piece separately, which becomes a little bit of a challenge. Don't see that regulation going away in a hurry. So that is something we have to live with. So yeah, these are the few things. Otherwise, frankly, I think rules are now fairly easy, and we believe we have enough limits to be able to increase our portfolio allocation towards this asset class.
Got it.
Vikram, sorry, just to
Sure.
add on one more point, because a couple of times co-investment was mentioned. So unlike, where the insurance sector, the banks are not restricted by, by this condition of not being able to do co-investment. So that also is a big fillip, for the bank to do direct investments, and if wherever required, co-invest along with the fund in names which are strategic for the bank to kind of do. So if there is a name which, for example, Ivy is investing, and we believe that there is a big strategic fit, for the bank to also kind of align their indirect equity investment as well. Up to 10% stake I can take along with the fund as a co-investment as well. So that's a big benefit which the Reserve Bank allows. And of course, if you believe that you need to up the stake there, you can always go to Reserve Bank for approval with the justification, and they do look at it, fairly positive.
No, that's a very interesting point, because in fact, State Bank of India actually did their co-investment, their first co-investment with us. They actually invested in Biryani by Kilo along with us in the last round that happened. And I think that's a very good sign that, if you're able to do that, it actually gives a lot more value even to the portfolio companies. But in fact, Kapil, you also talked about co-investments, and I think when you look at co-investments, I think you would look at more from a strategic angle, right? So, do you, look at it from the perspective of when you look at, your larger picture of your corporate strategy and think of a map that you built for your own corporate, and then are you thinking of partnering more proactively from the investing perspective and look for such opportunities? There are corporates who are also trying to build their own corporate venture capital arms, to be able to build more activity around this area. So any thoughts on that?
So yeah, I think we clearly seeing a lot of corporates, right? Reliance, JSW, PMG, and many others who have the proprietary venture capital fund, and they're actively looking at it. How we situated is, we've started late, and we also had a little bit of FOMO that, everybody is doing it and we're not doing it. But now I think the strategy for us is one, to partner with venture capital funds, so that, because we don't want to plan to set up large team and a specific setup for this. The second, to have specific opportunities which have integration with what we do, right? It could be supply chain, could be, say, something in renewable energy, could be something to do with Industry 4.0, right? Wherein we are looking at an opportunity, and I mean, we've almost concluded with the term sheet level for investing in some startup which is into fuel supply, right? So that's something which we relate to. We're a consumer there, we understand the pain points, and we can contribute to its growth. So those are the opportunities which may do directly, and that's where possibly co-investment in something we will be more than happy to look at. Right? Anything which we understand, which has some synergies with our existing businesses, and we see the potential, that's something we'll look at.
Very interesting. This morning, Mr. Kamath actually made very interesting comment, talking about if India continues to grow at 8% for the next 25 years, will be close to 25 trillion economy. And a large growth is actually going to come from the startup ecosystem, right? So we're going to see a lot more unicorns coming out of India, a lot more dragons coming out of India. And I think there will be disruptions, right? So there'll be a lot of new innovation which will be happening in this space. And of course, that also comes with a lot of risk, right? So that's a lot of risk is actually, front-ended. And as Prasun was saying earlier, the gross margin versus net margin effect is also there in the beginning, and the returns are back-ended. So I think given all these challenges, right? So, we're talking about a 10-year fund or a 12-year fund. We are also seeing global venture capital models where the global LPs are even going to a model of, no kind of tenure limit. So they're actually talking about, let it be a 40-year fund and no pressure on exit. So as long as you're building value, you're taking that early stage risk, you actually keep focused on building long-term value. So I think the question is, how do you see this? This tenure becomes very challenging from a venture capital perspective. When I sit here, I know that when I'm hitting my 10-year cycle, I have to sell my shares of my portfolio company so that I return the money. But would love to hear your thoughts in terms of how do you see this, cycle of, the pressure of returning capital within the time frame?
That's an interesting one, actually. See, to be honest, we are still awaiting the return of our capital from a lot of funds. Too early for us to really comment in terms of whether this asset class is working fully for us, what are the lessons for us, a bit early. So I think we're just 6 years into the journey. Probably another 3-4 years we'll have a much better idea. But having said that, I would empathize with the people who are managing it within a finite time frame. Sometimes it becomes very difficult, and especially during times of economic upheaval or certain external events, it becomes very challenging for funds. And particular years, certain funds, if they have to exit, becomes very difficult for them. So while there is some flexibility today, this entire model of having an unlimited time sounds interesting, but I think it will require a lot of thinking and also a lot more closer association between LPs and GPs. Today, I think most of us are still in, I'm not saying experimental stage, but still at a phase where we are still trying to learn. We are also trying to figure out what really works for us, which are the partners we'd like to work for. So eventually, possibly, we may end up choosing 2-3 such partners who we believe we can work from a 25-30 year point of view. And once that happens, it will be far more closer involvement as far as investments are concerned, their monitoring is concerned. Today, we are slightly more hands-off. So, but that's an interesting model and a thought which I think we will clearly look at over the years to come.
Yeah, Mihir?
Similarly, since the asset class itself is new in India, it's too early to say. But what our board has kind of guided us, the investment committee has guided us, is that you need to diversify. So not only are we diversifying across funds, so obviously not putting one big chunk in any 1 or 2 funds or 3 funds, we are diversifying across funds. But equally importantly, the guidance is to diversify across time. So we're not going to put big money in any one given year, but we're going to spread it out over a period of time so that we have at any point in time different funds of different vintages which are maturing and then recycle the capital. So as of now, the bias is to really have a finite maturity, spread it over multiple funds over multiple time frames, and then recycle the returns rather than going for infinite capital.
Understood. And Kapil, before I let you continue, I would encourage maybe 1 or 2 questions from the audience. So if you can keep the mics ready, if anybody has any questions. Continue.
So I would say let's date for a bit before we decide to marriage for long term, right? I mean, and it's really it's definitely a very interesting thought, but see, time period of 7 years, 8 years, 10 years is okay, but having an indefinite time, one more challenge there is, see, the world changes very fast, right? So maybe what you're doing is interesting to me today, but 10 years hence, will that remain equally interesting? We can't say, right? There could be something else completely different. I would better be off, putting money in venture capital than playing that field. So I think that will be a challenge to have a very long-term investment horizon.
Interesting. Ajay?
I think it's a very interesting question. And again, see, from a bank standpoint, like I mentioned, equity return from this investment is not the paramount criteria for us. So having said which, it's not, at least personally, if you look at it, I don't think we would be adverse to a longer tenor than what is prescribed today. Though, of course, making it indefinite would be maybe stretching it a bit too far. So, keeping some bit of flexibility to cater to some uncertainty. Like right now, I'm made to believe that there is a funding winter. So, it does make exits a little more improbable than it would have been maybe a year, 2 years back, right? So, there might be a need for funds which are maturing now. May not be able to get a good exit. So, the flexibility to maybe extend it for a few more period, could make sense. Likewise, the companies that you invest in, because of, whatever reasons, may not mature to the extent that you may have liked. So, I would believe that some bit of flexibility built in the whole model could be useful, is I think where I would like to see it.
Thank you. Neeraj?
Yeah, so I think if you look at from a bank's perspective, before VC arrived, we were investing in some kind of companies, for example, market infrastructure companies as promoters. And those of us who invested in NSE invested about 25 years ago, right? And I can take a few more examples, the clearing corporation, some of the rating agencies, et cetera, et cetera. So there is that part that we've been used to, where we've seen like multi-year, long horizons where we've made these investments, the returns are still coming. We've invested, or we lent to infra with a 15-year, 20-year horizon, so we're used to that as well. The size of VC investments or AIF investments isn't very large for us to make any big difference from a liquidity standpoint. So I don't need really liquidity about, it's not a big driver for the decision making. So can it be like, can 10 years become 15 years? Probably yes. Does it materially change the amount of capital that we need to set aside or any other risk parameters that we need to think about? Answer is no. So I guess from our perspective, given the focus, given what we are looking at this, if the investment horizon were to actually extend a little bit more, I don't think it will kill us. There has to be rationale, of course. Why do you want to do it? And if there has to be, if the fund is doing fairly well and the underlying investments are doing fairly well, I don't see a reason why extension should be a problem.
Good, I know I have run out of time, but I'll take just one question. You have the mic with you? If you don't have, you need a mic because we have a lot of online people watching here.
Sure. Just want to know your guys' perspective on exit strategy going through public markets. What I heard mostly is acquisition, exit kind of thing, because startups will thrive and the LPs will do well if there's a public market available.
Anybody wants to? So, I think, see, exits in general, of course, we had a session on exits this afternoon. And I think, the market, obviously, as you were saying, there's a funding winter going on. So obviously, there are cycles, right, which happen. So currently, obviously, if you're trying to exit, if you have the pressure on exit at this point of time, and if you return the money to your investors, obviously, it's not a best situation to be in. So that's the reason you always have these extensions in the fund, right? So you have this +1, which happens. So, but fortunately for us as IvyCap, I think we were able to make some good exits last year and in the last few years. And we were able to actually return substantial capital. In Fund 1, actually, we've already done something called DPI, which is distribution to paid in capital. Already about 2.7x of the principal. Fund 2, we already returned 35% of the principal back. So I think one has to time it properly. Obviously, there's a timing aspect to it. And, and obviously the companies, our portfolio companies, obviously we had that discussion around that. And, there is a very collaborative approach that works between the investors and the portfolio companies to time it properly. So that is, I don't know if I have answered your question.
My question more had to do
So the timing of, again, we have one company which is actually going IPO, which is actually happening next year. In fact, Bluestone is already filing for DRHP. It's already, in fact, they would have filed a DRHP already by now, but they've actually delayed it a little bit. There are few more companies in our portfolio which are IPO able, and I think should be able to get ready with the IPO by next year. I think current market situation is not ready for taking companies to IPO at this stage from a portfolio like ours. I think we've run out of time. Sorry. Thank you so much, all the panelists here. Really appreciate your time. And again, thanks. Thanks, everyone.
This is the same question, valuation. So don't worry. Guys, just 1 minute. We become requesting you to give the token of appreciation. Just a moment. Thank you so much, everyone, for such an interesting discussion. Thanks for your time.